So here we are at QuantCon, and I'm about to tell you guys something that has nothing to do with quantitative analysis per se, but it has everything to do with understanding how and why the strategy might work out of sample. Because what we do with Quantopian and a lot of other tools is we're always doing back testing, right? Everyone can back test anything, but it's really important to understand why is a strategy going to work out of sample. And what we're going to talk about here is basically a framework for at least trying to understand how and why that may be possible. So really, how do we understand our edge is what this is all about. And I'll tell you the story of how I kind of came to this conclusion. All right, so it's not working here. We got technical difficulties. Zap. Next.
We got some.
We can go old school. I can just tap it
All
too.
right,
I'll
cool.
use the laser pointer.
All right, sweet.
Easy day. All right, so how did my adventure start in this whole active investing thing? Well, I went to University of Chicago, and I used to hang out with this guy who thinks active investing is absolutely insane. Nobel Prize winner Eugene Fama. And what I did for my dissertation is I'd always been into value investing. So there's this organization called Value Investors Club. And I was like, you know what? These people are really smart. They do all this homework. They're these fancy hedge fund people. I'm going to read every single one of these dang things, catalog all that data, and do some analysis on it. Because I'm going to show this old, stodgy guy that value investing works. So, that was probably stupid, but that's what I did. So I spent a year doing this. Write on my dissertation, I say, hey, Fama, value investors have stock picking skills. This is the last line of my one of my papers in my dissertation. Send it to them. I get this email. Conclusion has to be false. And so I'm like, oh my God, I just spent a year of my life. I'm never going to graduate from this place. And you guys, a lot of you guys have PhDs. When you're in a PhD program, like, get me the hell out of this thing as fast as possible. So I run down to his office. I'm like, Professor Fama, what's going on here? What are we going to do? How's this going to work? And he's like, Wes, I agree with all your analysis. It's great. He's like, here's the problem. Words matter. He's like, you say value investors have stock picking skills. What you need to say is the sample of value investors you analyze have stock picking skills. So I was like, all right, cool. So I need to change a few words, and I can get the hell out of this place. And he's like, yeah, you could do that. You got to go talk to the other advisors, but you're out of here. So anyways, I come up with this idea, and I kind of convinced myself that markets are extremely competitive, but markets are not probably perfectly efficient, right? I think that's a reasoned hypothesis and reasoned evidence-based finding. Okay. Other life experience. Way back in the day, when I had more hair and it wasn't turning gray, I used to hang out with Iraqis. And right here, I was on embedded advisor teams, right? And I learned a lot about human psychology, not from behavioral finance, but from hanging around in chaotic places where your brain does weird things when you're not thinking straight, right? So here we are. We're at this checkpoint in a place called Barwana, which is a little village near Haditha. And we got two camps, rational people and irrational people. I happen to be in rational people camp for the first time in my life. What do rational people do when it's 2006 and you're in Al Anbar province? Well, we bring ammunition. Why? So you can shoot back at people that shoot at you. Okay. We also wear Kevlar. Why? Well, if a mortar hits that right there and a fragment goes towards your head, if you don't wear a Kevlar, you're going to die. So, let's wear a Kevlar. And of course, you can't see his, but you bring water. It's 120 degrees outside. You're going to die from heat stroke before you die from getting shot at, right? So this is what we do if we're quote-unquote rational system 2 thinkers. Here we go. No Kevlar. It's 120 degrees outside. The Kevlar's hot. Why the heck would I want to wear that? No ammo, except for what's in my mag. Why? 30-round mag of 7.62 is heavy. Screw that. I'm not going to bring it. And then no water because, Arab men, it's kind of macho. You're kind of a wussy if you drink water. We're not gonna have water, So what's the point? The point is that not just this guy here, but all of us, even quant people with PhDs, can get crazy, especially when you have a lot of stress or you're emotionally charged. And in financial markets, you get emotionally charged because it's your money. And making money is hard and you don't want to lose it. So you start thinking weird, right? So, all you got to do to become a billionaire then is, we know the markets are not perfectly efficient, right? And we know there's all these idiots out there. This is so easy, man. We're just going to go find the idiots, take advantage of them, and we're going to get super rich, right? Well, unfortunately, it doesn't work like that. Or all the finance professors would own private islands, and everyone who uses Quantopian would not be using Quantopian anymore because they would own their private island and be hanging out, right? This framework here is how I always try to understand edge. And I encourage you to use it. What it is you're basically playing a big poker game when you invest, right? And Buffett has this old saying that all you really need to do is when you sit down at the table, know who the patsy is, right? Because if you don't know who the worst poker player is, it's probably you. But that's kind of true. Because here's the problem. If you sit down at the table and you're like, all right, that guy's definitely the idiot, but you don't recognize that Buffett is sitting at your table too, you're still going to lose, right? Because that's what it's all about. Everyone thinks I just find the idiot, I exploit them, but they don't realize you're in a dynamic game. So real opportunity sits in this middle where we identify who we're taking advantage of, because active markets in equilibrium, every winner's got to be every buyer's got to be a seller, so someone's losing here. So we got to know who we're exploiting, but we also got to recognize that this city here is filled with people that are way smarter than I ever thought of being. So we need to know what in the heck are these guys doing, and why haven't they already taken advantage of said idiots? Only when we can identify the idiots and understand why the best poker players, who I'll never be, aren't exploiting this edge, do we have sustainable opportunity. And what I'll highlight here at the end is active investing is simple, but can't be easy in equilibrium. There's got to be some pain. So let's go to the first part, behavioral bias. And I always like to use value investing because everyone knows about it. It's intuitive. So if you're not familiar with it, the value anomaly is this puzzle in academic research where if you just simply sort stocks on cheapness metrics, any way measured, right? This is like basically PE, enterprise multiples, blah, blah, blah. It doesn't matter. These are CAGRs, annual CAGRs over this 40-year period. Cheap stuff beats expensive stuff by anywhere from 3 to 6 to 7% per year, okay? And we can argue about frictional cost and all these other things, but this is just an empirical fact. Every year, on average, this happens. So a lot of people argue, right? So in 1992, Fromm and French have their paper, and they say, hey, there's this thing called HML, and it has like this positive return to it. And it's basically value, like value stocks have better returns. And they all say, well, this is because they're riskier. The reason you make all this extra money is because these are just riskier securities. A lot of other people think, well, wait a second. I read Intelligent Investor. I study market psychology. Value investing seems to be driven by mispricing to me. So we got to have a study to figure this out, right? So this is a summary of a study, a paper I encourage everyone to read, Leconstruct Cipher-Vishny, 94, Journal of Finance. We're like, how are we going to figure out and determine is value anomaly driven by mispricing or risk? So here's what they do. They sort securities from expensive to cheap. This is just book to market. And then they look at the relationship between price and past 5 years earnings growth to try to ascertain what are embedded market expectations in prices on average. Well, expensive stocks have whooped it on, right? Why are these expensive? Well, you pay a lot of money for a stock because you expect that to continue, right? Why else would you pay a high PE for Facebook unless you thought it was going to grow at 30% CAGRs for the rest of eternity, right? That's why it's expensive. Over here in the garbage bin, these cheap stocks, they're cheap for a reason, right? They've done terribly. Who the hell wants to own a stock that's a total loser? And the reason it's cheap is because implicit or embedded in market expectations is this idea that this is going to continue to infinity, negative infinity. This is going to continue to positive infinity, right? Okay. So what do they find? Well, what actually happens to future 5 years earnings growth rates? And you can just pretend it kind of equalizes, right? Well, making money in a market is all about front-running expectations of other people before they think about it, right? So growth stocks are expensive, and this is expected to go on forever. What happens on average? It's never as good as people think. Facebook was growing at 30%, now only grows at 20%. Oh crap, it's not as exciting. Gets revalued down. You lose money on that expectations change, right? On average. Similarly, garbage bin stocks that everyone hates, the stories are terrible, it's going bankrupt, on average, are never as bad as people thought. You get a reversion in expectations, you make money on an expectational change, right? Buried in the data is the value anomaly, in part, is driven by an overreaction to bad news. Is there some element of risk? Probably, but you can't deny the facts. Okay, great. So there's all these idiots. Why don't we just all be like Warren Buffett and buy all these value stocks, right? And as we said, we identified the worst poker player, embedded overreactions to poor fundamentals in the short run. Why isn't everyone doing this? Another paper that you should read and memorize is Cypher-Vichy 97 Journal of Finance paper called Limits Arbitrage. And this is the most compelling idea that, as I've been working in industry and thinking about this for a long time, this thing summarizes the world's problem in asset management. It all boils down to this problem where asset management is often delegated. So you don't manage your own money, you hire someone who's apparently smarter than you to manage your money. Why is that an issue? Well, there's a principal agent problem here. Because what happens, and this is just a visualization of like their paper, they say, okay, 2-period model, I'm some genius hedge fund guy right here, right? At time 0. 2 periods out, I see this stock that I know is going to like go up 100%. And let's pretend you're that smart. You're the genius guy. You're God. Problem is, this stock from 0 to time 1 could either go down further, because markets can remain irrational, longer remain solvent, or it can kind of bleed towards fundamental value. And herein lies the problem. If I'm the hedge fund manager charging 2 and 20 with my awesome whiz-bang proprietary model, and I go to, I send out my statement, and I'm like, I'm down 50%, trust me, it's all good. This is such a great deal, we're going to go up 200% next period. The clients, who are often don't understand the underlying process, don't understand how markets work, are like, dude, you are so full of shit. Give me my money back. I'm out of here. Where do you see this right now? And I'm not saying these guys are smart, but it's ideas. Sequoia funds, Einhorn's funds, Akin. All these guys where I'm not saying they are this genius, but the argument is maybe they actually are, and they're just in a blowout situation where good luck convincing those investors to not do redeems. They're blowing it out the door, right? How can I liquidate these funds faster than I can even think about it? Well, the rational, business-minded, profit-motivated asset manager is thinking, wait a second, this is a great trade. This is a terrible business decision. Because in the asset gathering business, what you want to do is you want to get assets to charge fees on them, right? Once you get things rolling, it's kind of sticky and a pain to move asset managers. As long as you're kind of in the ballpark, you can kind of fake it and hire some PhD guys and say, hey, my performance is, if you adjust it for this factor, it was down, but it's not that bad, blah, 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 right? And people will be like, okay, whatever. But if you lose to the index in the short run by a lot, they're like, I'm out of here. Give me my money back, right? So this is a terrible business decision to do trades that have massive career risk, right? And most of the smartest poker players in the room get endowed with a ton of capital. And they have a ton of business career risk, so they really think about this. So now back to value. And our favorite value investor here, poor Warren Buffett, right? So generic value investing for a 6-year period got face ripped relative to the S&P 500, right? Every year almost it loses. Can you imagine holding on to a trade for 6 years underperforms, right? And of course, I'm not going to say the back half of this, but it ends up working out. Cover of Barron's magazine in '99. Warren Buffett's lost his magic touch, right? All these guys, if you held on to value stocks of this period, you didn't have a business, right? A lot of real famous people just went bust, or they adapted and started buying internet stocks, so they want to stay in business, right? So this is just a reality of the world. So, value is just an example I use to highlight how we can think through this sustainable active framework and identify something that we think could work out a sample. Why? We identify some sort of mispricing component that seems to be driven by market participants' just inability to form expectations correctly on average. And then we also realize that all these really good poker players don't want to touch some of these trades with a 10-foot pole, right? And that's good because that limits our competition and prevents arbitrage mechanism. And so in the middle, you have these active opportunities that backtest well, but because their human minds are always going to be corrupted and the best poker players have to worry about their job sometimes more than like compounding long-term capital, these are sustainable opportunities. But to exploit them, you need to have weird capital, right? You need to, in order to exploit real anomalies that are sustainable, you need two things. It's not just about how smart you are. Every guy I know, we all know the same stuff. You know, it's the same database. We all get quantopian squared, you know, blah, blah, blah. You got your machine learning, you know, whatever. Who cares? In the end, if it actually works out of sample, because everyone else on the street has these same computers that do all this stuff, if it's a 2 sharp and you can grind, you know, 50 bips a month with no risk, it's gone. Period. It's too competitive. So it needs to be painful. But in order to exploit painful long duration arbitrage opportunities, you need to have weird money that can be the bag holder at maximum pain when everyone says, values, that's for old guys, man. We don't do that. Or momentum hasn't worked the last 10 years. That's a stupid strategy. And that those people contribute to the very anomalies that long duration capital is exploiting. So real arbitrage comes in the form of matching long duration capital with long duration arbitrage. But what does the industry do? They couple short duration capital with long duration arbitrage, and that's called a bank run, right? The bank runs. Everyone wants their money out of value or whatever the hell it is. Now everyone's running for the exits and just making the opportunity that they're set out to exploit in the first place, which is ironic. So in the end, sustainable alpha, if you're not the smartest poker player in the room, is basically all about long horizon and the discipline to essentially hold the bag at maximal pain. Now, some of the quantopian crowd, I imagine, and what they hope to achieve is they want to actually be the best poker players. I've determined I can't do this. There's too many damn smart people. I gave up. I'm just not that smart. Some people are really smart, and I met a few of them. And that's why I don't compete against them, because I'm like, I'm not going to compete against you. However, you never want to be old kitty cat here fighting against the bald eagle who's about to like rip out your eyeballs, right? And on the street, there's a lot of people that have massive incentives and get paid a lot of money, and they're willing to beg, cheat, and steal and do whatever it takes. So unless you are equipped to win, be very, very careful with overconfidence. Because I can't tell you, I've like memorized the Chris CompuStat database at this point, and I've seen, we work for a huge family office, and I get pitched crap all the time. I've seen everything. And 1 out of maybe 1,000 strategies in the best poker player game, I think are actually legitimate. And it's usually tied to like some edge these people have that it's kind of like you're thinking, well, this edge ain't lasting, or they're kind of in the gray zone of like, well, is this even legal? And then you got to make seriously, and you got to make a decision as an investor, like, do I want to take like brand risk and integrity risk here? Because most best poker players, I'm not going to name names, you see them sometimes in the press after 10 years, they go to jail, or the SEC has to change the rule because they're cheating, right? And you got to know, am I so smart that I can beat the people that are actually cheating? And that's a huge hurdle. So I would just end, if you're trying to be the smartest poker player at the table, just be really careful with knowing your real edge. And if you're not the smartest poker player, just do boring, dumb strategies like value and momentum, and just get ready to like look like an idiot a lot of the time and have people say you're stupid, and just go find money that's got 20-year horizon. So that's your choices. So anyways, that's just a framework. So when you guys are back testing and thinking about strategies and is this going to work out a sample, at least now you have a framework to understand, do I have a real edge here? And if not, you might want to try a different strategy, I imagine. Or you can be a good salesman and raise capital on it. That'll work. A lot of people do that too. But it's not intellectually probably going to work at a sample. So any questions about this stuff? Or sir?
So on the value graph you showed,
Yeah.
the real expensive stuff fails, but I think from a momentum perspective, the real expensive stuff is
I'm sorry. Say a little bit louder.
The expensive stuff fails on your graph, but depending on your time frame, that expensive stuff might do well, like from a momentum perspective.
Sure. Yeah. Definitely. So, and momentum's kind of its own beast. And there's an interaction where you're right, like just raw expensive stuff as on some fundamental like price to fundamental metric is on average a bad bet, right? Momentum is different, like, because it just deals with the P, the price. When the minute you do price over fundamentals, that is a different proxy that captures a different error, right? It's basically overreaction to good news that gets extrapolated out in the future. P, i.e. things that are attached to momentum, is ironically actually an underreaction. It seems what the data and a lot of the research say, underreaction to positive news, right? So if you got unexpected earnings surprises, and those keep coming out. It's almost like, the world for momentum trading, which is just price only, is not price over fundamentals. That's a different beast. But in the pure, that expensive there was just some P over some fundamental. That seems to proxy for bad bets, like 2-7 hands in poker, not aces. And sometimes they work. Like if you look at if you look like a distribution of all expensive securities, they have some winners. And guess what? People love lotteries and they overpay for them. So even though the left tail has like a ton of like massive drawdowns, and on net it's like a bad geometric compounding strategy, there's always a hero. And people have self-attribution bias. When they get the winner in growth, they're like, oh yeah, I'm so skilled. I know this tech stuff better than everyone. When they got the losers, they're like, oh, that was bad luck. I didn't know the Fed was going to do that. And so they code it as like they actually know what they're talking about. But the data is clear. Expensive securities have a horrific distribution for a long-term geometric compounder, at least historically, right? So, yeah. And yeah, if you integrate momentum, that's a way to kind of deal with the issues of just straight expensive. But that's kind of another thing we could talk about. I just use value as an example for that framework. Sir?
One of your best blog posts was called diversification.
Mm-hmm.
My question is, how do you explain that to clients and the risks they're taking, and
Yeah.
kind of keep them
So,
they understand that that's kind of the sweet
yeah.
spot?
So the problem with that is we recognize the career risk, right? So we talk to like big CIOs and they're like, yeah, this stuff's great. Here's a problem. When my clients get the statements, even though they're supposed to think like a portfolio, and the idea is you have like a high conviction, ton of active risk strategy. If you put it in a global portfolio, if you believe in modern portfolio theory, it's going to like move you up and to the left on your risk return trade-off because a lot of that risk kind of washes out. The problem is people like to mental account and look at each individual line in the portfolio. And if you have clients that do that, or they're not sophisticated enough to understand how a highly concentrated, massive tracking error active strategy works inside a portfolio structure, you're going to get fired, right? Because every few years, they're going to look at their statement, they're going to be like, oh yeah, the bond's looking good. Look at this. What did this thing underperform by X? And they're going to like blow that out. And you're like, well, you got to understand, this is a global portfolio where we take these active risks, just focus on the portfolio level. But that's really hard because you need sophisticated clients and a sophisticated like education communication plan to people. Like another one's like managed futures. Like everyone's like, who the hell wants to own managed futures? Because we haven't had a blow up yet. Because it's long tail risk basically. So everyone's blowing out. They're like, that's a stupid strategy because it's an insurance program. And then in another '08 happens. They're like, we got to have managed futures. Did you guys see what that did? And so you should have managed futures all the time, right? Because it's long tail risk and it's giving you amazing kind of diversification benefits. But that's not how people think. They always look at their lines within and they're always like messing with it, right? So it's how can you get people to think in a portfolio sense, like you're supposed to, and what we all got taught, and what I teach students all the time. Yes, is that how the world works? No, because I hang out with my dad all the time. He's not a finance guy; he's a veterinarian, and he'll be in his brokerage statement. He's like, these oil stocks, man, get those out of here. I gotta, he's always thinking it like within. He doesn't think in a portfolio sense, even though you can tell people till you're blue in the face, hold like super active exposures, pool them, and you'll get a better Sharp. But everyone likes to think individual asset Sharp and fail to account for like diversification, which is what you're supposed to learn in like school, like when you went to business school or whatever. So that's the challenge. And then, for me personally, we use ETFs to basically deal with tax issues. I'm all in on value momentum, insanely active, because I got 20-year horizon. I don't care. I'm not going to fire myself. And, we just work with people that, think like that as well. But for other users, they can't do that. Maybe if they want like an active value momentum, they got to do some smart beta thing. Or they can buy a Vanguard fund and buy a little part of value momentum, and make a financially engineered smart beta deal. But it just really depends on your clientele and who you work with. Because if they basically create career risk for you, you're going to contribute to the anomalies. And like value last year's a great example where everyone asked me like, well, why do you think value is going to get arbitraged away? I'm like, yeah, it could, for sure. Let's go look at how many people are subscribing to value funds at the end of last year. None. People are running out for the exits, redeeming their faces off to get their capital because value's dead. That's why it works. Like strategies that work have to have massive pain and disbelief where people are like, this is dead, the model doesn't work, these guys are idiots. And that, ironically, is why they work. So if you have a strategy that doesn't have massive pain, and you pay more than like a Vanguard fee for it, you're wrong. Because things that don't have massive pain don't work. They're not sustainable, right? Because it's easy to arbitrage. And the best poker players in the room, if they know they can make a little edge easily and they won't have any risk of getting fired, all the capital in the world is going to be in that trade and it's dead, right? So unless you find people who are the cheaters and the people that are the best poker players in the room, but they're also the best poker players in the room. So if you invest with them, do you think you get any of the economic rents of their value add? No. It's called 4 and 50 fees, right? And that all goes to them, not to you. You were better off buying the Vanguard bond fund, with maybe add a little satellite S&P on it. Because after the fees, the taxes, they got rich. They're the best poker players in the room. And they convince you of that. But because they're the best poker player in the room and you're kind of not, they convince you they're smart, but it still doesn't win for you, right? So they're so smart to outsmart you in the end still. And so it's challenging to play the game, basically. So, but yeah. And the diversification post is about that. Like, as you get more active, you have more expected long-term benefit, but you now take on a lot more career risk. If you can't communicate to whoever you're dealing with that they need to think in portfolio sense, not individual asset sense. So, but that's really challenging. So, any other questions? Anyone got any whiz-bang strategies that work? Happy to put you in touch with funding. You just have to go through our gauntlet of due diligence, where I'll ask you, what's your edge and why isn't everyone doing it? No one ever can address that question. Many people can't. If you can, we know a lot of rich people that like to make money. But we just got to be convinced it's sustainable. So, all right, so we got no more questions. All good. Appreciate your time.